Welcome back to the channel of Truth, Trust, and Transparency. Today, I wanted to run you guys quickly through due diligence of a live deal I had sent to me by someone, and I want to show you why it has failed. But there's a really, really good lesson in this particular property. And once you guys have found those sorts of suburbs and you're talking to real estate agents, I think it is extremely crucial to remember that, we can build up the relationship and that rapport with the agent. That's what we can do, and that's how we get the off markets, and that's how we get the opportunities. But at the end of the day, two things. One, the real estate agent is paid by the person that owns the property to sell it for the highest price. So regardless, you got to remember that agent's intention is always to get the biggest price from you. The second, what you need to remember is that an agent, and most of them, are trained assassins. They are trained sales agents. They are trained negotiators. That's what they do day in, day out across hundreds and hundreds and hundreds of deals. So you need to remember that these guys know every single trick in the book. I can remember even when we had Scotty Agate. He was an agent for 20 years in the property investment course too. He did the section about the tricks that they play. And even I didn't know some of them. And when he was telling us, I just thought, wow, it is crazy. But the agent is a trained assassin. Majority of them, like all industries, there's good agents, there's bad agents, but they are trained to try to get the most out of you in their bids. So you really, whilst the quick sale is always good because, speed wins or loses deals, it does not mean that we can forego parts of the due diligence period in order to make the transaction. And I'm going to show you exactly why. And I think this particular deal is a really good example of you guys needing to have your head screwed on and make sure you can do the steps quickly, but I don't want you to go from one to step, 2 to step 6 and miss the ones in between. Still transverse those steps quickly and in the sequential order in which you need to complete them, but do not skip steps just to get the deal over the line. And I'm going to show you this property and why I think it is a great example. So this particular property, depending on when this episode goes live, is still on market. $585,000 price range, 33 Moona Street, Warrnambool, Victoria, 3280. We know Victoria is very popular with people. But before I dig into suburb and property specific, I need to go back to the due diligence, look at property data, then look at suburb and the layering of, environmental ramifications before we go into the due diligence specifically. So I'm working in the H-Tag platform here at the moment. This is what we also use in the course. So anyone that uses property data, I like H-Tag the best. So we go through it. Typical price is $590, which is on par with what we've heard. RCS score is quite high, which is great. Dwelling size 18,700 and population of 31,000. Perfect. No bushfire risk. Potentially small flood risks. Really good healthy population and dwelling size. Obviously, population dwelling size doesn't mean capital growth, but remember, we do need a pool of people there that is sustainable to be able to ensure, and that it is growing, to be able to ensure growth of our asset. Now, the most particular graph that I always look at and I think is important is the growth rate cycle. For Warrnambool in particular, it has been a steady performer. It hasn't been, up 10%, down 10% and going like this. And then in those particular markets, they're very volatile in terms of, losing money quickly, gaining money quickly. I like to see something that's been a long-term performer over 25 plus years. Remember, people always say, you can't rely on past data. But at the end of the day, that's all you have. You don't have the future data. So, if past performance we can look at and establish the trends and the way it is moving, that will give us confidence to predict the future rather than try to find the future data, which you don't have yet. So here in the growth rate cycle, look, it has been steady. It hasn't been great in terms of its performance over the last 10 years. It's probably almost below 5% for a good 7-8 years there. It also had the COVID swing. Where it is at the moment, it's increasing, which tells me it is at the bottom of that growth rate cycle, which a lot of Victoria is currently. If I go down a little bit more, URSAD score. So URSAD, for people playing along at home, that's the socioeconomic score of the particular area. When we get down into that cheaper range of sub 6, we expect the URSAD to head towards, 1, 2, 3s, and 4s. That is a lower socioeconomic area compared to an URSAD of, say, 10 out of 10. That would be your most affluent areas. So it's okay there. The renter to owner ratio is 30%. That's a little on the high side, but I've been working with some members of our course, and I know that anywhere between there's some options in this price range for lower than that, but that's not too much of a red flag just yet. Demand profile is spread 3 bedders, and there's obviously opportunities left and right between 2 and 4 bedrooms. Affordability is sitting right on 30 years to own, so that's also another important metric trigger in that particular price range. Because remember, if it is unaffordable to the residents that live there, then it is a good chance that we will not see the owner occupiers pushing that growth. It would be the investors pushing that growth, which would then see, obviously, we would see some sort of correction when the people that live there aren't able to afford properties in that area. Days on market is decent, 33, cool. Vacancy rate 1.4%. Hold period 10.25 years. Stock on market 0.23. Let's have a look. Stock on market long term has been slightly decreasing. Short term over the last 12 months is decreasing. That's cool. Inventory. This is not good. Inventory currently is increasing over the long term. Building approvals slightly decreasing. Hold period, it is up to 10.5 years. So it's telling me people there buying in Warrnambool and they're staying there for a long time. Here's some things that don't sit really well with me. The days on market are slowly increasing. It's not by a lot, but they slowly are. And the vacancy rate is, it is very topical, and over time it has been increasing. Last 4 months it has been decreasing, but it tells me that there are a few amber flags there that I want to look at and monitor to give myself a little bit more confidence. I know personally that there are better options in Melbourne for this particular price range. So when you're thinking about assessing a suburb, it is not, and one thing that, Matty Jolich from HTAG always says that I've sort of picked up and I really agree with and resonates with me is that when you're looking at, definitely sub 600K price range for property, not all data points are going to be perfect and give you all green flags. Because if they were all perfect and gave you all the green flags, it wouldn't be sitting at 590 grand to buy. It'd be sitting a lot higher. So it's not about are all the data metrics perfect. It is for the money I want to spend, is this the best option? And I think if you can change your thinking to that rather than is all the data perfect, is your budget. Is this the best opportunity for my budget at this current point in time? I know for this price range it isn't, and there are better options out there. Maybe I will do a video on Melbourne and my top areas, but I'm getting amber flags here. There's some good things, there's some bad things. Let's jump into the property in particular. So 33 Moonah Street, Warrnambool. If I'm looking around inside, cool, nature reserve. It is on, it doesn't look like too much of a main road. Okay. Fresh. Kitchen has been redone. Floors have been redone. This has had a absolutely new renovation. Downlights. Fireplace. One thing I always say as well to people, and I'll say it till I'm blue in the face, is don't underestimate the strength of having a bath in a particular property. Remember, if the demographic in which that you are buying in is families love baths for smaller aged children. Cool. Oh my God, this hurts my OCD, but I mean that's That hurts my OCD so much. If that was my house, I'd be ripping that shit out straight away, but that's not a reason not to buy it. Man, this house is extremely newly renovated. Every single area is newly renovated. It's got a nice backyard, low maintenance for renters. Okay, there you go. That's your garage. Let me see the floor plan. So I enter here. That wall sort of blocks it off, but dining and kitchen, that's flowing. And then we have bedrooms that are all really decent sizes. Positioned at the back of the block, not ideal, but we can live with it. One thing I always double check is what story can I learn on Google Maps when I just quickly have a look. Russell Creek walking thing. Now, the issue that I picked up with this particular property, it's sitting on Russell Creek. It's the first house. If Russell Creek floods, now, I'm not a resident of Warrnambool, so I don't know if it does or not, but I know that if Russell Creek floods first, this particular property is going to get it. So that led me to Google. So the first thing here, Warrnambool flood maps, just quick high level. I click onto this. This has come up, Warrnambool flood guide. Let me see. Okay, so if this map shows potential flood risk for you, ensure you take an action plan. Blah, blah. The map below shows the expected depth of a 1% and 20% flood. Of 1% flood means that there is 1% of a flood this size or larger occurring in any year. I don't like my chances, 1% floods. So this is what I do. I look at this map, locating myself northwest Racecourse Reserve. That's a really good visual indicator. Northwest across next to the basin. Northwest straight across. Let's have a look at the flood map. Zoom in a little bit more. So this is the racecourse. This is the basin. Let's have a look. I'm in 500%. Okay, let me look at the street configuration. So we've got this street that's shaped as a W. And between the second and the third street, that's where my property lays. I go back to here, got my street as a W, and between the second and third street is where my property lays. Ladies and gentlemen, that is an absolute fail. It tells me that this property floods. It tells me that that's probably why it's had a renovation. And it tells me why this particular agent and the person that sent it to me said the agent wanted a quick sale. Now, I'll get that the agent's sometimes wanting to sometimes get the deal over the line, but I think this is a key lesson here. Look, I get that the agent wants to get a deal over the line and get it over quickly and is potentially looking like he is helping you to be able to do that. But this is what they do. This is the game that they play. They wanted a quick sale and it was off market. The person that sent this to me was excited and I said, whoa. Let's ensure that we still complete the due diligence process, and just because they want it done quick doesn't mean that we need to skip anything. The agent in this particular case wanted it quick. I hate to say that he's trying to do the wrong thing. However, my gut instinct is that their particular sales strategy is to go in there, want a quick sale, someone to come in, not do that level of research, which, geez, it's probably taken me 10 minutes. God forbid anyone that buys that property and doesn't. But it tells me that the story of that particular property is potentially the fact that it had flooded previously. They have renovated the house and are looking to move on and sell it somewhere else. If I also look on a listing, when did they last sell this as well? Because if they've sold it in the last couple of years, sold price history. If they've sold this in the last couple of years, it tells me that it flooded in the last couple of years and they did the reno. There you go. It's sold in both 2021 and 2023. It sells every 2 years, probably because the people that buy it don't understand that it floods and they buy it, it floods, and they sell it to the next person. So for me, it's a no-go. Insuring it will be hard. Managing as a tenant would be an absolute nightmare. Avoid at all costs. Red flag. No deal. Look, if there is something on market or a house that you guys want to assess for a video and so that we can all learn from it, feel free to send it in. I've got in the show notes as well how to contact me and get in touch. But really appreciate it. I'll see you guys tomorrow.